In an earlier video, we talked about overall balance of payments, accounting issues. And again, the balance of payments is a list of all the transactions and goods, services, and assets between a domestic and foreign, agents, be it private or public. And the concept of double entry bookkeeping ensured that the total credits equal the total debits, because every time there's a transaction on one side, by design, we put a transaction of equal value on the opposite. So for every credit, there's an equal debit. We also talked about how you can, before we get there, because of this, we have the overall balance of payments has to be equal to zero in this broadest sense. The balance of payments can be broken up into various subcomponents. The merchandising trade balance, which reflects imports and exports of goods. Services balance. The financial account balance, which is the sale or purchase of financial assets across borders. And the official settlements balance, which has to do with buying or selling official reserves by a central bank or a government. These top three are private transactions, sale or purchase of goods, services, or assets by private individuals. And this last one is by the government. And this is going to play a role when we talk about fixed exchange rates or when there's intervention by a central bank to affect an exchange rate. But that's for another time. So, given this, double entry bookkeeping and these accounts, we have that the NTB plus SB plus FAB plus OSB equal to zero. That's another way of saying the total credits equal to total debits under double entry bookkeeping with the balance of payments accounts. So each one of these accounts can be quote, out of balance. Overall, it will be in balance. So I have 4 transactions here, and I want to show you how these would show up in the actual balance of payments accounts. Okay, first, U.S. imports $100 million worth of cars. Now, the importation of the cars are going to be, that's going to show up as a $200 million debit. That's the actual recording of the value of the cars coming in. But those cars have to be paid for. They have to be paid for by essentially exporting a check equal to $200 billion to pay for these cars. So that's the $200 million credit because you export the check for the importation of the physical cars. U.S. exports of $80 million in agricultural goods, okay, the $80 million that show up in the merchandising trade balance, that's the exports of the actual product, and then the payment for that by foreigners is an $80 million debit because you're importing the check. So each one of these transactions, 2 goods transactions, have both credit and debit of equal value. We've got a U.S. exports of $80 million in financial services. Now this is not an asset. This would be, say for example, a bank or insurance company providing services to foreigners. That is going to show up as 20 million credit for the exportation of the services, and the importation of the check to pay for it is going to be in the debit side. The U.S. sale of $40 million in stock to foreigners, that's going to be $40 million in the credit by the actual exports of the stock, the payment for which is 40. Okay, so far just debits and credits. But now we can use the concepts that we've talked about before, to start looking at these sub categories. Okay, first, let's take a look at the merchandising trade balance. There's $200 million worth of imports, $80 million worth of exports. You have a trade deficit, loosely speaking, of minus 120. You're importing more goods than you're exporting. We have a service balance of positive 20. Okay, in this hypothetical situation, you're not importing any services, you're only exporting. So we've got a deficit in the merchandising trade balance. We've got a surplus in the services balance. Okay, the sum of these two, the merchandising trade balance and the service balance, is the current account balance. And what we have here is that we're importing $100 million worth of goods and services more than we're exporting. You're importing 200, you're exporting 100 of goods and services. The financial account balance, well, we've got 240 credits, we've got 140 debits, and what you're left with is a financial account balance of 100. We're exporting assets. Okay, a surplus means that you're exporting more than you're importing, so we're selling off assets more than we're importing them. But the overall balance of payments is 0. Now I'm going to give an interpretation in another video about what a current account deficit means. Just say now that that means you're borrowing from abroad to pay for your purchases of goods and services. But this example shows how this overall balance does not mean that individual components are in balance. And also we are able to get a sense of how are we doing on the goods side, how are we doing on the services side, how are we doing on the assets side. Now if we had intervention by the central bank, you would have an OSB being in surplus or deficit. That would change this a bit, but we'll come back to that. Okay, so this is a quick overview of how a balance of payments accounts would work in practice. I want to point out we have got other econ videos at this YouTube channel. If you're interested in this or learn more about this and other economics concepts, and especially international concepts, please feel free to visit.